Now, regarding how to identify supply and demand zones, we will use individual candles. For me, the demand zone will be the last candle before the market has a strong bullish impulse, and the supply zone will be the last candle before the market has a strong bearish impulse. Some people have a rule that you must use the last down candle before a push up, or the last up candle before a push down. But for me, the color of the candle doesn't really matter. I don't care if it's a bullish or bearish candle. What I care about is the final candle before the impulse. The reason is that the last candle before the market breaks away strongly usually indicates the area where large buying or selling pressure has accumulated, because immediately after that, the market moved very powerfully. Typically, the last candle before an impulse will look like a doji, like this, barely moving and having wicks on both sides. That is the type of zone I want to use to identify supply and demand zones. Upon entering the new uptrend phase we just analyzed, the market had a structural shift from bearish to bullish. We have a lower low, then a lower high, followed again by a lower low. And then the market breaks up to create a higher high, from which the uptrend begins to form. As soon as the market breaks above this higher high, that is when we start looking for a buy entry. And this is also where we use supply and demand. Obviously, since the market is currently in an uptrend, our focus will be the demand zone. We only buy at demand in an uptrend and sell at supply in a downtrend. As I mentioned earlier, the last candle before the impulse is where I want to find an entry point. Here we have this doji candle, a candle representing indecision with wicks on both sides. And we will use this candle to identify the demand zone. This will be a demand zone because the market viewed this price area as a discount zone to buy. At the same time, this is also the starting point for a new movement leading into an uptrend. Therefore, this demand zone will be the area where we look for buying opportunities. And when the market returns to this zone, we will be ready to buy here. Our buy order will be placed around this area, more precisely along this price zone. When using supply and demand to buy, we typically enter the trade at the top of the zone and place the stop loss below the zone. This means the stop loss will be below the bottom of the demand zone to ensure a safer entry point. So assuming we enter a trade at this demand zone, this would be the buy position and the stop loss would be here. And our target will aim for the higher peaks above, because we know the market is currently in an uptrend. And as you see, as the market continues forward, that is exactly what happened. So now we have combined market structure with supply and demand. But there is one more factor to understand, which is the theory of market efficiency and inefficiency. This theory suggests that the market often moves in two different states, efficient and inefficient. An efficient market is when price continuously moves up or down but always returns to retest previous supply or demand zones. You can see in this phase, the market pushes price up, creates a demand zone, and then returns to retest that demand zone. That means no price gaps, imbalances are left behind. Every time the market creates demand, price pulls back to retest that zone. Conversely, an inefficient market is when the market starts creating price gaps like these. You can see in this movement, the market creates a demand zone and then has a very strong bullish impulse leaving that demand. This tells us the market is in an uptrend, but the price has not yet returned to retest that demand zone. Therefore, it leaves behind what we call an imbalance, or a zone of price disequilibrium. This open price movement gap, specifically the area below this bottom, is the imbalance or inefficiency. And when such inefficiency zones appear, there is a very high probability the market will return to fill that zone at some point in the future, before continuing to move strongly in the main trend direction. Therefore, if the market pulls back as I just drew here, even if at that moment we see a break of structure occurring, we are not in a rush to view it as a new downtrend, because we know there is still an inefficiency zone below that the market is likely to return and fill. Typically, not many trades take place within these unbalanced price zones. So when we see an open inefficiency zone like this, we will pay close attention to the possibility of the market pulling back there, because almost no orders were filled in this zone, while the majority of orders are waiting below. And when those orders are triggered, it opens opportunities for reversals or new movements in the market. Now let's apply this directly to the chart. We already had a structural shift to an uptrend and have also marked the demand zone. And with the knowledge just gained, you can see that the market is actually leaving an open price zone right here. Looking from a lower time frame perspective, the market has created higher highs, higher lows, and continued higher highs, higher lows repeatedly. Then in this area, the market begins to break part of the structure to the downside, but that isn't enough to turn the market into a complete downtrend. Instead, we only view this downward movement as a retracement for the market to return and fill the inefficiency zone. This also means that if there is a sell, our maximum target would only aim for this demand zone. Because when the demand zone is filled, there's a high probability the market will react here. Price will fill the inefficiency, touch the demand zone, and then bounce back up. And that is exactly what happened on this chart. So when you understand market efficiency and inefficiency, you'll see these are extremely good zones to set targets for short-term trades. We can absolutely look for short-term sell opportunities through this zone, and at the same time, we can use those very zones as entry points. By the way, speaking of this, we would never want to buy at a demand zone that has lost its inefficiency. For example, here we have a demand zone and the market has already retested this demand zone before. Buying at the first retest is perfectly fine. But after the demand zone has been retested, it's no longer suitable to continue using for subsequent buy orders. Therefore, this zone will be completely invalid for buy orders because there is no longer any inefficiency zone existing here, while the demand zone below still maintains its price imbalance area. So this is the good zone to find an entry opportunity. If we put everything together, the market initially had a break of structure to the downside. Then it broke structure back to the upside, bringing the market back into bullish price action or an uptrend. After that happened, we identified the demand zone that started this push-up, which is this demand zone down here. And right above the demand zone, there still exists an open price area, also known as inefficiency or imbalance. That further increases the likelihood that the market will return to fill this price area. And it makes this area a buy zone with a very high winning probability. Because at this point, we know the market has returned to an uptrend, so the target also becomes quite clear. We can aim for previous peaks, for example, this peak area, or hold the trade longer to aim for those empty supply zones above. In fact, we can absolutely view this supply zone as a potential target while the trend continues upward. So with a simple and easy to understand setup, we will place a buy limit at the demand zone. The stop loss is placed below the demand zone, and the target will head toward the old peaks in the trend or those supply and demand zones that still have imbalances above. In this example, since the market is currently in an uptrend, our target will be the supply imbalance zone still open above. And as you see, the market then continued to rise and filled this entire price zone. To be fully transparent, the setup I just showed you was not a trade I directly entered, but the next setup I'm about to show you is a trade that I actually executed, and it uses exactly the same type of price action and concepts we just learned. In fact, this is an even safer and higher quality setup. For me to show you this next trade example, first you need to understand the concepts of swing structure and substructure. Don't worry, it's not too complicated. Basically, swing structure consists of the major market movements. For example, when the market is in an uptrend, the swing structure is the significant moves that form that trend. When looking at a market like this, we know it is bullish from a swing structure perspective. But importantly, within that large uptrend, especially during the corrections, smaller trends will exist. For example, if we are looking at an uptrend on the 4-hour time frame, then within lower time frames like 1 hour or 30 minute, we can see bearish price action and downtrends appearing during the correction phases. This means that smaller trends will always exist within the larger trend when we switch across different time frames. And as traders, we can absolutely use lower time frame structures to better confirm trades. If we believe the market has just formed a higher low in an uptrend, then we can use the substructure and lower time frame trends within the larger trend to find their own structural shifts. For instance, in this declining market, we have a lower high followed by a lower low. Then the market breaks up to create a higher high. This becomes a bullish confirmation signal on the lower time frame. And once we have bullish confirmation on both the high and low time frames, that confluence will help the setup have a much higher winning probability. That is exactly how we find the highest quality entry points. I don't want to confuse you with too much theory, so now let's go back to the chart to see how it works in practice. This is the trade we just analyzed. We have a break of structure here to create a higher high. Then the market drops to retest this zone and forms a higher low. Then the market begins to push up again. And this is also when we apply the swing structure and substructure concepts. If we take a quick look from an overall perspective, we can see after the shift from bearish to bullish, the market has now entered a bullish swing structure. In other words, the higher time frame structure we are currently observing is clearly bullish. Therefore, our priority will be finding buying opportunities. Now, focusing on the leg from this peak down to this bottom, this is where the substructure concept starts to appear. We can see that within that movement, smaller trends exist. First, the market created a higher high, then a higher low, followed by another higher high. Then the market broke down to create a lower low, followed by a lower high, and then the next lower low, then another lower high. And finally, the market formed a bottom here. This shows that within the correction leg of the high time frame uptrend, there actually exists a clear downtrend on the lower time frame. In other words, when looking at the market in more detail, we see a small bearish trend inside the large bullish trend. We have this zone as a potential lower high. And this zone is even clearer. This is definitely a lower high. Therefore, what we need to wait for is a trend break to confirm that the lower time frame structure has started to align with the bullish higher time frame. We have seen the bullish trend on the high time frame, so now we want to see the low time frame also shift to bullish. And as you see here, when the market pushes up and breaks through these structural zones, that confirms that the lower time frame is now in agreement with the higher time frame. This also means we can use all the concepts we just learned to find a much safer setup. Now that the lower time frame structure has confirmed bullish, the next things we need to do are: first, use imbalance to identify open price zones. Second, use the last candle before the impulse to identify supply and demand zones. After that, we will be ready to start looking for an entry point. At this point, the market has become an efficient zone because prices return to fill that previous demand zone we analyzed. Next, the market shows a structural shift on the lower time frame by starting to create higher highs in this area. Then price pulls back to fill the market's imbalance or inefficiency zone, simultaneously retesting the demand zone. Therefore, if we place a buy limit at this demand zone, with a stop loss placed right below the bottom, and continue to apply the same target identification method as before, that is, aiming for the old peaks in the trend or the supply imbalance zone still open above, then this supply imbalance zone will become our target. We will then have a confirmed entry point. And the reason this setup is called a confirmed entry is because we aren't just relying on the higher time frame structure to find the trade, but we also see that very same pattern repeated on the lower time frame. In other words, the same structure is appearing on a smaller scale. This shows that the high time frame and the low time frame are completely in alignment with each other, and that is the type of setup for the highest winning probability. Next is risk to reward, which is the ratio between the amount you risk and the profit you can achieve. For example, in this trade, we only risk 1% for the chance to earn 6% profit. This means you actually only need to be right about 1 in every 5 trades to be a profitable trader. Of course, with a system that has a win rate around 50%, you will win more than that. But this provides psychological comfort because you don't need to win every trade to maintain profitability. And that is how you can use 3 simple price action concepts to build an effective trading system. If you've watched this far, you've definitely learned something from this video. And that is a small but extremely important step on your trading journey. Class Trading Gold hopes to accompany you on this path, not just with knowledge, but also with the mindset and discipline to survive long-term in the market. Press subscribe to the channel right now because every single day, we will bring you a new video, updating you on the most important and practical knowledge in trading. See you in the next video.